That's it. The era of private equity outperformance is over. Turn off the lights. It's time to head home. Don't forget to tip the waiter. Well, not so fast, Billy Ray. We've already discussed the concentration of AI stocks driving S&P returns. And the PE return benchmarking results still look favorably on a 10-year basis compared against other non-S&P indices. But let's look closer for some added context on the long-term history. In particular, performance on a rolling 10-year basis. Looking here, there are very few points over the last 25 years where public markets outperform private equity. When this did occur, there are two key takeaways. First, the public market outperformance was fleeting, typically lasting less than 12 months. Secondly, the subsequent 3 to 5 year period saw a reversion to private equity outperformance, somewhere in the neighborhood of 800 to 1,000 basis points. Not too shabby. What about private credit? For all in doom and gloom surrounding that asset class, the strategy has gone a perfect 24 for 24 vintage years of outperforming. Both infrastructure and real estate have generally outperformed benchmarks since the global financial crisis, including in all mature vintages since 2012. Here's a fun one, perhaps in a sign of the apocalypse, the perennially bullish GPs capitulating in their return outlooks. This year, our GP survey indicated greater bearishness for private market returns going forward. But let's not get carried away. Only 4% of GPs expect public markets to outperform. That number's up from a whopping 0% in 2023. And 10% of GPs think it'll be roughly a push. Finally, the need for diversification and the ability to find alpha generation opportunities are big determinants of where to put capital across your portfolio. Unlike the public indices where spreads are shrinking, you can see that the dispersion of returns between top and bottom quartiles in the private markets has not really narrowed over the last 45 years, especially in the equity categories. This is all despite meaningfully growing assets in the private markets. Quite simply, private markets have more choice, more investment opportunities, and offer greater diversification.